Hey everybody, this is Paul doing a video on March 31st. It is 10 a.m. Central Time and the market is currently open. As you can see, we got a little bit of a rally on our hands. So I kind of want to go over this, my thoughts on the banks. Been a very eventful last 15 days. Very eventful. So, where are we at? What happened? The very, very, very simple explanation of what happened in the last 15 days is, as I pointed out in my last video when it was kind of going down, is the banks got a lot of exposure and did not think their depositors would flee. So they got a lot of exposure to things that they should have been hedged against, which means they should have had like basically like an insurance against it. And the smaller banks especially, anytime the depositors start to flee, they immediately get a credit crunch and they immediately have to start selling their assets to cover liabilities. Like, it's just the way that banks trade. It's a 10 to 1 system, or 9 to 1 basically. You loan them $10, they loan out $100, or you give them $10, they loan out $100. Is kind of how our banking system is set up. It's very prone to being if there's a run. But you got that government backstop with FDIC, so everybody thought everything would be okay until you get something like a Silicon Valley. So I don't think it's a coincidence that Silicon Valley happened on the exact same weekend as Bear Stearns back in 2008. I don't think it's the Federal Reserve. They were raising rates then too to slow down the housing market, which they saw was starting to get very overheated, and they weren't expecting things to blow up. So in that situation, we have way more tools now, but that doesn't mean the risk is past. And why do I say that? You can look at the bond market right now. The Federal Reserve on the 14th, I believe, or no, on the 22nd, sorry, raised rates to 4.75 to 5%, and the 2 year is sitting at 4.118%. What that tells you, and anybody who can tell you what's going on here, is the market does not believe the Fed. 'Cause if you listen to the Fed, they're still talking about keeping rates tight until 2025. This market has rate cuts priced right now this year in July. So somebody is wrong. And that's very simple. That's the very simple. There's no ifs, ands, or buts. And the reason why I think somebody's wrong is because if you look at today, for example, you kind of look at the bond market, what it's telling you. You look at oil. Oil's kind of back above 75. Okay. Dollars, not at the ridiculous levels that it was. It's down. Okay. So what we're looking at is you're looking at a market rally, and the reason why market's rallying is because the inflation data today, which I believe I got a screenshot of. I hope I got a screenshot of. But the inflation data today was supposed to come in at zero point 0.4, it came in at 0.3. So that tells you that the inflation data is coming down. Now, that's a good thing. And what the market kind of thinks is once we get close, we're going to hit that 2% level. Um, we're going to hit that 2% level far quicker than what the Fed thinks. And just to give you a general idea of how quick we can hit that 2% level, if we post the same thing that we just did, you could be there by June. But the Fed thinks we're not going to hit 2% inflation. Like, literal Fed members come out and said 2025, which is I don't understand what these people are looking at. Um, I've shown this chart before, and what this chart does is it's literally a range of possibilities. That's what this chart is. So what happened was is when I showed this chart before, if we kept posting those point ones and damn near like those, we would have hit the 2% target much quicker. But what had happened was is beginning of the year is very very hot because you had huge Social Security increases and huge minimum wage increases across multiple states and just tax returns and everything coming in. So you got up here, so it kept it. That's where the sticky inflation narrative came in. So the Fed is still over here in this camp. See this camp over here? This is where the Fed is at. The Fed thinks month over month we're going to be zero point 0.4 to zero point 0.6 or even higher. That's just where they're at. Okay? So this is where the Federal Reserve is. This is where the market is. actually. If you look at where the market's at, this is what the market is looking at. So the market is kind of thinking that inflation is going to come down quicker, but they're also thinking that there's going to be a blow up. And the reason why I think the reason why the market thinks there's going to be a blow up is you can look literally today at what's getting hit and what's not participating in this rally. And it should be able to tell you kind of what's going on here is if you kind of look at it. So FRC's up, which is amazing, which is hilarious. But different banks are down, like Zions is down, Comerica. Now, why are these banks specifically down? So this is a report that I see people taking a lot of screenshots of, posting it on Twitter, and then not giving credit to the people that actually made this report. This report is extremely detailed. This is commercial real estate exposure of the regional banks, and pretty much all the big banks too. And I'm going to post this in the little description of the thing. But if you want some light reading, here you go. This thing is a monster, and it is a beast of like a report that has just shocking levels of detail on bank exposure, just pretty much across the like retail, like apartments, hotel, industrial, like who has like different scenarios for losses. This report is amazing. But what you're seeing on Twitter, especially, is people take screenshots of this thing and then they just post it, and then they're not giving any credit whatsoever to JP Morgan, who put this together. And I saw a guy finally link it, so I was like, let me. And this actually goes over individual U.S. bank commercial real estate exposure. And commercial real estate is where the problem is because office vacancies are ticking up at a very significant rate, far above what they were in 2008. So this is where people think the next shoe is going to drop in terms of the Federal Reserve is going to have to step in. And then this is kind of like at the very end right here is a very good chart that just breaks down all of this. So you can kind of get the general idea. So like SIVB, for example, right here, um, you can kind of see what their exposure is or was to these different things. SBNY is on here also, but you can kind of get the general idea of the ridiculous exposure some of these banks still have. And it went up. So you see anything that's above 100 is probably on a target list right now to be shorted. And if you want to know why things like Zions is getting shorted so hard, so if you go over here, you can see this directly in the market. You see this right here? We have this huge rally today, and some banks aren't participating. This is why some banks aren't participating, is because this is what the market thinks that the next shoe to drop. Comerica, I think that's them right there. Yeah, CMA. So you can get the general idea of one to one what's going on. And this is where I think the market thinks the next shoe is going to drop, is because the problem is occupancy rates stay high. Like they're losing occupancy in these markets because of like work from home, that kind of thing. When they have to roll those loans over, they're not rolling those loans over at the COVID lows of like, very low rates kind of stuff. They're rolling those loans over at this stuff. So keep your eye on like commercial real estate, auto loans, that kind of stuff. Any banks that have exposure to that, because that's where the market thinks the next shoe is going to drop, and you can literally see it in what's selling off today and what's still selling off. Um, so that's kind of where we're at. But the market is rallying right now because the Fed basically stepped in and did a massive amount of intervention. So the banks that they think are kind of like getting less exposure, that don't have the exposure to this stuff, those are the banks that are rallying right now. Um, any of the big banks, they're rallying just because they're the big banks. They're going to get bailed out anyways. So you can kind of see that, I think, probably around here somewhere, but in the dial and that kind of stuff. So that's where we're at. So that's that part right there. So let's see what we got here. So I guess let's just go over some more charts and whatnot. So this is the different lending. So this is a chart that's being posted. For this chart, so this top part up here is basically SVB. This is their bailout up here. The two that you want to pay attention to are down here. If banks start using this less, that's going to tell the market that the banks don't have as much stress as they have before. Everything's going good. Now the problem with the everything is going good narrative is that means that the 2-year needs to reprice up in a very big way. I have a feeling that's going to happen probably in April. And right now, this market is rallying because all of this came down from pretty much like almost 5% down to where it's at right now. So that's kind of what's going on. You also have in the background, so let's go over to the portfolio here. So I have this view right here, and you can notice this right here. And if you notice something, I've been adding money every single day to this right here. And why am I adding money to that? It's very simple. When I posted my last video and I was looking at different money market funds, this was at 4.4%. That's what that was at, 4.4%. We're 15 days later and it has gone up almost every single day. And I believe there's a little chart that they have around here somewhere that actually shows you that. Yeah, so this little chart right here shows you what it started at. So this is what it was at, and there you go, right there. This is right here, March 1st, it was at 4.43, and now it's at 4.75. This like this yield right here, you cannot pretend that doesn't exist. If you're a dividend investor, it already beats it. I could sell literally every penny of this right here, all this 21,000. If I wasn't going to take a $1,300 loss and dump every dime of it into here and be perfectly fine with that decision. Um, for example, AFB, for example, this is my municipal one. Now, the good news is, so this is taxable and this is non-taxable. But I could dump every penny of this if it was at zero, put it in here, be perfectly fine. O, for example, dump every penny of this. This is at 4.9, but at the rate this is moving, it's going to be 5.0 here pretty soon. Once the market gets to the realization that the Fed is not going to cut, and the Fed is probably going to, so what the Fed said is basically that they're going to probably have one more rate hike, so somewhere between 5 and 5.25, but the market doesn't believe them. If the market starts to believe them, you're going to see a sell-off. Like all of this is going to sell off. You're going to see a big time sell-off. So this is probably going to go back down to where it was, like in the 3,900 range, 38, like in a 38 to 3,900 range where it was trading at. If this starts to price in, if people start to believe the higher for longer thing, and then you go back into, well, we're just playing the waiting game of this. We're just literally playing the waiting game. That's what we've been doing this whole time. We're literally waiting for the data to catch up with reality and to get to here. And we're also hoping that there's not a recession in the process. Also, if you start to see job cuts, immediately you're going to see the market rally because the 2 year is going to drop like a rock. Now, one thing that I did notice is when the market did de-risk, so de-risk is the word, I guess you want to use it. When the market decided that it wanted to de-risk, this fund right here specifically took a hit. And the reason why is, that you can kind of see, is it pulled back to 39 again. And I probably should have added at that point, but you can kind of see it pull back to where it was in October. Basically, people pulled money out of the market extremely quick. Even dividend stocks took hits, took massive hits, pulled out money extremely quickly and put it into money market funds in a very big way. Now, here's the thing about money market funds. They go up until they don't go up anymore. And then people start pulling money in a very big way. So, what's going to happen is you can kind of see. So this is a $127 billion fund. I think when I looked at it before, it was $123 billion. So it's $4 billion that have pretty much been added in like a week. So people are obviously piling into these funds, and you can kind of see what they're made of. Those reverse repos, repo facility kind of things that you keep hearing about, that's what this is. The Fed is literally paying you. It's kind of a weird way of doing, but the Fed is literally paying you, or paying these guys, and then they're distributing the money to pull money out of the market. That's what this is. That's literally what this is. So that's why they're able to offer this rate right here. So you're like, well, how are they offering this rate? Is it the 2 year or whatever? That's because this is a short dated fund. So this is a very short dated fund. week average maturity, I think, is like 16 days or something like that. So they're rolling this fund over constantly. Um, and there are a lot of people piling into this fund. Now, what happens whenever, when they cut rates or they start talking about cutting rates, you're going to see this number drop significantly. So you can kind of get a general idea. Um, when this fund was here, so you can see 0.05, I guarantee they barely had any money in here. But once you start doing this, look at this monster jump right here. You can just look at this. Everybody's going to pile into that. It's almost about as close as you can get to a risk-free return. It's pretty close. These things have failed in the past before, but that's because they had a lot of housing exposure in 2008. Um, so these are the things right here. This right here, what you're looking at, this money market fund, is literally what's killing the regional banks right now. These money market funds are literally killing the regional banks because there is no reason whatsoever to have your money in a bank that's giving you a 0% yield. There's just none. There's zero reason to have your money in a 0% yielding fund. So this is what's basically soaking up all the money right now is these money market funds. I went through this one. This is Morgan Stanley. That's because that's who owns. So you can see who owns E-Trade from Morgan Stanley. So they offer this one. Schwab has one. As you can see over here, I'll put like $2 in there. I might end up growing this one, but right now I'm currently growing. I haven't even checked the yield on this one in like a few days, but I guarantee it's higher than that right now. So I'm adding money into this one right now because this is my core portfolio. I don't see any point adding it into the IRA unless I had some kind of like guarantee that like over a 30-year range it would be higher, because if I did that, you can kind of get the general idea. If I had that, I didn't get no return whatsoever, So right now it kind of makes sense if I pile a whole bunch of money into it, like, because it's a taxable thing, and then I wouldn't get taxed in the IRA. So it's a good thing to add to your IRA right now, and then get out of it once it goes back, if it goes back down to zero ever again. So that's kind of where we're at. This is kind of what we're looking at right now. For April, I'm not even sure what to tell you what's going to happen. My assumption is if the market starts to believe that the Fed is going to do higher for longer, this is immediately going to go up by a lot. And when it does, this is immediately, and these two are going to immediately sell off. So, and that might happen as soon as tomorrow. These guys like to wait until the first to do this kind of stuff on people. So that's why I'm not adding money into the market right now. The only place I've been adding money for the past, since I did my last video, is right here. And I've added $1,200. Every single penny I've made from DoorDash in the last week, or just about every penny I've made, if you can see. This was my investment rate because I have to use this money for other stuff like gas. So every other, every penny I've made just about has gone into that money market fund, and it is literally rock solid. Um, it's kind of crazy. I checked this morning, and it's actually higher than it was this morning when I checked it. If you want to get the insanity of just how fast this is going up, pretty soon this is going to be yielding 5%. If you want to get a general idea. So that's where we're at right now. Right now, the core issues of the market are not fixed. The market is rallying because rates are just lower. The the inflation number came in lower, but that doesn't change the simple fact is that on the back end you have this going on. Is that every day that they have to roll these loans over at higher rates, it's it's causing more and more weakness, and you're gonna see it in these banks over here until they end up getting bailed out. So I think that's where we're at right now. Um, just be careful being exposed to these banks. Very careful being exposed to these banks. I think the last 2 weeks I've given you an idea of where your weaknesses in your portfolio might be. So you might want to kind of look at that and see if you want to be exposed to that. And then also, like I said, if you want a risk-free thing, just jump into a money market fund. Do some research on them, but as far as I can tell, they're pretty awesome. So y'all have a nice day. Leave any comments, question, that kind of stuff in the comment section. Thank y'all.